Here's a number that should terrify you. $455,000. That's the median home price in America right now in January 2026. Not in San Francisco, not in Manhattan. That's the median, meaning half of all homes sold cost more than this. And here's the even scarier part. The median household income is $87,730. So we're asking the average American family to buy something that costs over 5 times what they make in a year. If that sounds unsustainable, congratulations. You understand basic math better than the entire housing market. Today, we're doing something that real estate agents hate. We're calculating who can actually afford a $455,000 house in 2026. Not who can get approved, not who can technically make the first payment, but who can afford this without turning their life into a financial disaster. First, let's be clear about what $455,000 gets you in 2026. In most American cities, this buys you something painfully ordinary. We're talking a 3-bedroom house, maybe 1,500 square feet, a 2-car garage if you're lucky, and a yard that's more decorative than functional. This isn't luxury. This isn't even particularly nice. This is just a house, a normal, basic house that your parents probably bought for $180,000 back in 2005. But here we are, and this is the market we're living in. The question isn't whether this makes sense. It clearly doesn't. The question is, given current mortgage rates, current incomes, and current costs, who can actually make this work without slowly drowning financially? Let's find out. Before you even get to worry about monthly payments, you need to get in the door, and that means a down payment. The traditional advice is 20% down. On a $455,000 house, that's $91,000 in cash. Let me say that again, $91,000. The median savings account in America has around $8,000. So we're not talking about being a little short. We're talking about needing more than 11 times what the average household has saved. Okay, you're thinking, I'll just put down less. Fine. Let's say you scrape together 10%. That's $45,500. Still a massive amount, but more realistic for many buyers. Here's what happens when you put down less than 20%. You trigger PMI, private mortgage insurance. This is a monthly fee you pay, typically $200 to $350, because you didn't have enough cash up front. You're literally paying extra every month for not being wealthy enough. So you're already starting from behind. Let's say you manage to save that $45,500 for a 10% down payment. You now owe $409,500. With current mortgage rates at 6.2%, your monthly principal and interest payment is approximately $2,510. But that's just the beginning. Here's what else you're paying: property taxes and insurance. Generally, they represent 9% of the total PITTI, principal, interest, taxes, insurance. Then add PMI, about $275 per month until you hit 20% equity, maintenance fund, about $380 per month, 1% of home value annually, and you will need this. Let's add it up. Mortgage, P&I, $2,510, property tax, $420, insurance, $300, PMI, $275, maintenance, $380. Total, $3,885 per month minimum. And this assumes nothing breaks unexpectedly, which it will. Now, here's where it gets brutal. Financial advisors recommend you spend no more than 28% of your gross monthly income on housing. That's not being conservative. That's the standard guideline to avoid being house poor. If you're spending $3,885 per month on housing, and that represents 28% of your income, you need to be making $3,885 divided by 0.28 is $13,875 gross per month. That's $166,500 per year. Even if we use the more lenient 43% debt-to-income ratio that banks use for approvals, you still need $3,885 divided by 0.43 is $9,035 per month. That's $108,420 per year. Remember what I said at the beginning? The median household income is $87,730. The median American household can't even hit the lenient 43% threshold, let alone the responsible 28% guideline. Let that sink in. The median-priced home is unaffordable, not just for the median income household, but for those making over six figures. They're barely scraping by. They're house poor. Here's what I need you to understand. Everyone in the real estate transaction has an incentive to get you to buy, regardless of whether you can truly afford it. The mortgage broker gets paid when you close, the real estate agent gets their commission when you sign, the bank makes money on 30 years of interest payments. Nobody wins when you say, "Actually, this doesn't work for my budget." And here's the insidious part. We've normalized financial struggle as part of home ownership. We've rebranded barely making it as adulting or being house poor, like it's a cute rite of passage, instead of what it actually is, people living beyond their means because the housing market has become completely disconnected from wage growth. Home prices have increased roughly 380% since 1990. Median household income up only about 190% in the same period. The math is broken, and instead of fixing it, we've just accepted that being stressed about money is the price of the American dream. Look, let me be direct about who genuinely, comfortably can afford a $455,000 house in 2026. Comfortable tier is $165,000 plus household income. They can actually enjoy the house they're paying for. Manageable tier is $135,000 to $165,000 household income. For them, payments are doable but require budgeting. Stretching tier is $110,000 to $135,000 household income. They're one major setback away from trouble. Risky tier is $87,000 to $110,000 household income. For them, buying a house is a recipe for foreclosure. But the harsh reality is about 75 to 80% of American households fall below the comfortable tier. Most people looking at median-priced homes are entering risky or dangerous territory. I'm not telling you to give up on home ownership. I'm telling you to be honest about what you can actually afford. Here are 4 strategies you could consider when thinking about buying a house. Strategy 1. Adjust your price range. Take your gross household income and multiply it by 3, not 5, not 6. That's your realistic home price. For example, you only look at a $450,000 house if your household annual income is $150,000. Strategy 2. Increase your income first. If you're making $90,000 and want that $455,000 house, you need to focus on earning more before you buy. That might mean career advancement, job switching, additional education or certifications, or side income. Strategy 3. Wait and save aggressively. Keep renting, invest the difference between rent and what that mortgage would cost, build real wealth, and wait for either your income to rise significantly or the market to correct. Strategy 4. Consider different markets. $455,000 in Seattle gets you a small townhouse. $455,000 in Columbus gets you a genuinely nice property. Geography matters enormously, especially if you can work remotely. Look, there's no trophy for buying a house you can't afford. There's no award for being house poor. The only thing that happens is you trade years of financial peace and flexibility for the ability to say you own a home, even though the bank really owns it for the next 30 years. The real question isn't, can I get approved for this mortgage? The real question is, will buying this house actually improve my life, or will it just mean I'm constantly stressed about money while living in a nicer building? For most Americans in 2026, a $455,000 house isn't a dream home. It's a financial nightmare disguised as success. The housing market might be broken, but your financial future doesn't have to be. Thanks for watching. If this saved you from a terrible decision, hit subscribe. And if you're feeling stressed about housing prices, you're not alone. You're not failing, and you're not crazy for thinking this system makes no sense. See you in the next one.